This section of chapter 10 we'll talk about depreciation. Depreciation is the process where we're going to allocate the cost of a plant asset to an expense in the accounting period's benefiting its use. And so for depreciation, we're going to do an adjusting entry for depreciation. And this can be year end, depends on when, maybe month end, just depends on when companies close their books and do adjusting entries. Okay, and so on our balance sheet, we have the asset and its acquisition costs. And in the chapter, they deal with all those costs that are included in the cost. Basically, the cost to get the asset and get it ready for use. And then what we're going to do is depreciate this. And so we're going to take the cost and we're going to allocate it over the life of the asset, and then record a depreciation expense. And that's going to appear on the income statement. And so there are three ways that we're going to look at in this chapter on covering on doing depreciation. And the first method that we're going to look at is the straight line method. The straight line method is our first method that we'll look at, and we're going to take the cost, and we looked at this a little bit in chapter 3, minus the salvage value, and we're going to divide it by the useful life, and that's the years that we anticipate using it. And then this is going to give us what we call annual depreciation, and that's depreciation for 12 months for a year. So if you're doing it monthly, then you know you need to take that number divided by 12. And then the entry for depreciation, like I said, we did this in chapter 3, is you're going to take and debit depreciation expense, and you credit accumulated depreciation. And this is a contra asset. So do not credit the actual asset account that appears on your balance sheet. You're going to credit accumulated depreciation. So let's do an example here. Let me thin out this pen a little bit. And if we have an asset, an equipment that cost us $154,000, and we're going to say that it had a salvage value of $25,000. Okay, if you take the 154 minus the 25,000, that gives you 129,000. And this is how much we're going to actually depreciate. And so it's called our depreciable basis. How much of the cost that we're going to depreciate. Okay, so if I take this and put it into our formula, remember we're going to take 154,000 minus the 25,000 salvage value, and then we're going to divide it by, and we're going to say this is a 4-year asset. We're going to divide it by 4 years, and that gives us 32,250 per year. 32,250 per year. And so if we kind of do a little chart, let's say we bought this in 2015, and so we start off with 154,000 of book value at the beginning of that year. We're going to take depreciation of 32,250, and so that's my depreciation expense. And then my accumulated depreciation that appears on my balance sheet after the first year would be the 32,250. Okay, and it would leave me an ending book value, that's a BV, of $121,750. And I got that by taking my cost, my original cost of $154 minus the accumulated depreciation, and it gives me my ending book value. And so then if we go to the next year, remember my beginning book value was $21,750, and not necessarily that you do a column for that, but I'm just kind of going through the process. I'm going to take, once again, $32,250. Under the straight line method, you take the same amount every year. And now my accumulated depreciation is $64,500. Because if I take $32,250 plus the new depreciation, I get $64,500. My ending book value then is $89,500. Okay, I'm going to try to squeeze my other 2 years in here. 2017, my beginning book value is $89,500. I take another $32,250, and my accumulated depreciation now is $96,750. So notice my I accumulate it. It keeps going up every year. And as my book value goes down every year, my book value is now $57,250. And then in the final year, 2018, I started out with a book value of $57,250. I take another $32,250 of depreciation. My accumulated depreciation final number is $129, and that should look familiar. And then my ending book value is $25,000, which also should look familiar. That's the salvage value. And so basically under the straight line method, and any method as you'll see as we go on, the accumulated depreciation should end up totaling that depreciable basis, and your ending book value should be equal to your salvage value, because that's the part that you're not depreciating. So that is straight line. That's your straight line method. If we scroll up, our next method that we're going to look at, it's our units of production method. Our units of production method of doing depreciation. Our units of production method. Let me give you another color here. Okay, our units of production method. We start out, there's 2 steps we want to look at. Hopefully you can see that. I wanted to make it thinner. You're going to still take your cost minus your salvage value. So that is still the same. Let me thicken that up just a little bit. And then we divide it by, instead of dividing it by the years, we're going to divide it by the total units of production that we expect to get out of this asset over the useful life, or the 4 years, similar to what we were using. And what that's going to equal is what we call our depreciation per unit. And so this number is the same. It remains the same. It's not going to change. So we're going to use this depreciation per unit every year. Same amount. Okay? And then step number 2 is then you take your depreciation per unit number, and then you're going to multiply that by the actual units produced. You're going to multiply that by the actual units produced. Okay? And then that will equal your depreciation expense per year. Now this number is going to change every year, not unless you happen to produce the same units every year. Okay? So our units of production, it is based off, the depreciation is based off the number of units produced. So it's not the same amount every year. Okay, so let's take my same problem that I had where we had an asset that cost us $154,000 and we had a $25,000 salvage value. But this time, let's say that I anticipate for the life of this asset that it's going to produce 180,000 units. And when I do that division, I get 0.72. So that's my depreciation per unit. So what I'm going to end up doing then, so let's look. Let's say in 2015, in our first year, that they produced 60,000 units. That represents my number of units that I produce. I'm going to multiply that times my 0.72, and it's going to give me a depreciation expense of $43,200. So that's the amount of depreciation that I take that year. And if we kind of follow our same chart, my accumulated depreciation then would be $43,200. And then my ending book value, that's a B, would end up being $110,800. So let's do the next year. And every year that, we'll have to tell you how many units they produce. So let's say in the second year we produce 55,000 units. I'm going to multiply that times 72 because remember this number is not going to change. Same number. And then I would get depreciation expense of $39,600. My accumulated depreciation then becomes $82,800 and my ending book value is $71,200. 2017, let's say they produce 70,000 units. I'm going to take it and multiply it times 0.72, and then I get 50,400. And if I add that my accumulated depreciation, it would be more than my depreciable basis. So if you remember that we can't have an accumulated depreciation more than 129,000. So I wouldn't be able to take this full 50,400. I'm only going to be able to take 46,200 because if I take 46,200 plus 82,800, it gets me to the 129. I cannot depreciate more than my depreciable basis, and your ending book value would be 25,000. It cannot go below the salvage value. So under your units of production method, you take your cost minus the salvage value divided by your total units. And so those are the first two methods, straight line and units of production.